Hey folks, welcome back to this edition of Ben's Bits. We're continuing our series from last week's video about bond laddering, which was very well received. We had tremendous feedback from it. Quite frankly, it was a little overwhelming because of your interest in it. So we will be fast tracking that video I mentioned we were going to make about going further into detail on that specific strategy, going more into depth on how we utilize it, how we implement it, things of that nature. So just give us a little bit of time to get that together for you, and we'll get it as soon as we can. So today, however, we're going to be transitioning back into a series about retirement. And for those of you who are newer to following us, we've had multiple videos about this topic in the past on our other platform. And they're still there for your viewing pleasure. And we're not going to rehash them per se, but we are going to revisit a few of the topics, especially in light of 2020, to see its effect on the investor's portfolio. First, I want to reinforce that while we tend to be more note-centric because of the many benefits that having them as the primary investment vehicle gives us, we're very asset agnostic in that it depends on what the point of the investment is. We always ask, is this investment congruent with our investment vision, our investment desires? And you probably guessed it, is it in line with what matters most? When you're thinking of adding a certain investment to your portfolio, you should do so with the thought in mind of the desired outcome. If you remember back to the income versus growth video, that video supports this philosophy because it presents the differences between the two, which are substantial. Most people can't retire when they want to as the result of imprudent or incorrect implementation. By adding the wrong investment vehicle, which delays sometimes for years, but it delays the intent behind the acquisition because it postpones what you're wanting in the first place. There's a question that needs to be asked as to why most people aren't able to retire early. And as a result, they end up having to work longer. And we're specifically talking about those who have any sort of portfolio or investments in general. And that question is my capital having to do double work? And what I mean by this is the investments that are contained within the portfolio, are they having to do twice the work? Because it has to replenish the capital that goes to fees or expenses. And then it also has to grow. But it isn't going to increase with the best potential when it's working with less. Or, more poignantly stated, it's easier to grow significant wealth when less money is taken out. So it's great food for thought here, and this is the thought process that we'll be dissecting over the next few episodes. So that's it for this edition of Ben's Bits. Join us next week as we continue this journey together. As always, thank you for watching, and we'll see you next time.